This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Today's discussion delves into the intricate world of banking regulations, specifically focusing on the Federal Reserve Act's Section 23A relations with affiliates. It's a complex area, but crucial for maintaining financial stability.
Indeed. Section 23A is a cornerstone of banking regulation designed to prevent conflicts of interest and protect the financial health of member banks.
It's about limiting the risk member banks take on when dealing with their affiliates, right?
Precisely. The core aim is to prevent excessive risk-taking through transactions with affiliates, ensuring that such dealings don't jeopardize the bank's capital or stability.
So let's unpack the key restrictions. What are the main limitations Section 23A places on transactions between a member bank and its affiliates?
The Act sets quantitative limits. A member bank and its subsidiaries can engage in covered transactions with any single affiliate up to 10% of the bank's capital stock and surplus. The aggregate limit across all affiliates is 20%.
That's a significant constraint. What constitutes a covered transaction in this context?
It's quite broad. It includes loans, investments in securities, asset purchases, the use of affiliate-issued securities as collateral, guarantees, letters of credit, and certain derivative transactions that create credit exposure. Essentially, any transaction where the affiliate benefits or receives funds is scrutinized.
And what about the purchase of low-quality assets? Are there specific rules around that?
Absolutely. A member bank can't purchase a low-quality asset from an affiliate unless an independent credit evaluation was conducted before the affiliate acquired the asset. This prevents affiliates from offloading risky assets onto the bank.
The definition of affiliate is critical here. How does the Act define this term?
It's multifaceted. An affiliate can be a company controlling the bank, a company controlled by the bank's controlling company, a bank subsidiary, or a company controlled by shareholders who also control the bank. It also includes companies where a majority of directors overlap, investment funds where the bank is an advisor, and any company the board deems to have a potentially detrimental relationship with the bank.
That's a wide net. Are there any exceptions to this broad definition?
Yes, several. Companies solely holding bank premises, conducting safe deposit business, or holding U.S. government obligations are excluded. Companies gaining control due to debt collection are also excluded for a limited time, subject to board approval for extensions.
The Act also specifies collateral requirements for certain transactions with affiliates. Can you elaborate on those?
Yes, each loan, guarantee, or credit exposure to an affiliate must be secured by collateral. The required collateral value depends on the asset type. U.S. government obligations require 100% coverage, state obligations 110%, other debt instruments 120%, and stock or real property 130%. Importantly, low-quality assets are unacceptable as collateral, nor are securities issued by the affiliate itself.
So the higher the risk of the collateral, the higher the required coverage. That makes intuitive sense.
The Act does provide some exemptions. Transactions with banks controlling or controlled by the member bank at an 80% share level are generally exempt, as are ordinary correspondent banking deposits and immediate credit for uncollected items. Loans fully secured by U.S. government obligations or segregated deposit accounts are also exempt.
Are there any other exemptions worth noting?
Yes. Purchasing securities of certain types specified in the Bank Holding Company Act of 1956, purchasing assets with readily available market quotations at those quotations, and purchasing loans originated by the member bank and sold to the affiliate with recourse or repurchase agreements are also exempt.
The Act also addresses banks with financial subsidiaries. How does it treat these subsidiaries in the context of Section 23A?
A financial subsidiary is explicitly defined and treated as an affiliate, not a subsidiary, for the purposes of Section 23A and Section 23B. This is crucial to prevent circumvention of the regulations. There's also an anti-evasion provision to prevent affiliates from indirectly extending credit or investing in the financial subsidiary's securities.
The board has significant rulemaking authority under Section 23A. What powers does it have?
The board can issue regulations and orders to administer the section, prevent evasions, and provide additional exemptions. These exemptions require a finding of public interest and consistency with the section's purposes, and must not present an unacceptable risk to the deposit insurance fund. The process involves notification and potential objection from the Federal Deposit Insurance Corporation and, in some cases, the controller of the currency.
So there's a collaborative effort between the different regulatory bodies to ensure appropriate oversight.
It's important to note that Section 23A has been amended several times. The Garn-St. Germain Depository Institutions Act of 1982 significantly revised the section, and subsequent amendments have further refined its provisions. The effective dates of these amendments and any subsequent rules are carefully considered to allow banks sufficient time to comply.
Let's talk about the practical implications. How does this section impact the day-to-day operations of member banks?
It requires careful planning and due diligence for any transaction with an affiliate. Banks need to meticulously track the aggregate amount of covered transactions to ensure compliance with the percentage limits. They must also ensure that all transactions are conducted on terms consistent with safe and sound banking practices. Internal controls and compliance procedures are paramount.
And what are the potential consequences of non-compliance?
Noncompliance can lead to significant penalties, including fines and enforcement actions from the Federal Reserve. It can also damage a bank's reputation and erode public trust.
Given the evolving financial landscape, how relevant is Section 23A today?
It remains highly relevant. The increasing complexity of financial instruments and the interconnectedness of financial institutions make it even more crucial to prevent conflicts of interest and excessive risk-taking. The section's provisions continue to serve as a vital safeguard for the stability of the banking system.
Are there any areas where Section 23A might need further refinement or clarification in the future?
The rapid pace of financial innovation, particularly in areas like fintech and digital assets, presents ongoing challenges. The board will likely need to continue adapting the section's definitions and exemptions to address new types of transactions and relationships. Clearer guidance on the application of the section to emerging technologies will be crucial.
So Section 23A is not just a static set of rules, but a dynamic regulatory framework that adapts to the changing financial environment.
Exactly. Its ongoing evolution is essential to maintain its effectiveness in protecting the financial system.
That was a great discussion. Thank you for your insights.